Here's how you can become a bank, lending your hard-earned money while earning interest on monthly payments. So in this video, I'd like to talk to you about peer-to-peer lending as an alternative investment. What is it? Is it worth it? How risky is it? Can you actually make some passive income while lending your money to others? Let's get started. So peer-to-peer lending has been on my radar for quite some time, especially now with the stock market at all-time highs. I wanted to put my money to better use than buying these stocks at an all-time high. So I decided to finally take a leap and fund my Prosper account. I put $5,000 in, and I'd like to show you how that works. Now this video is not a platform review, so I'm not gonna go into depth on how Prosper could be improved, and it really should. I just want to talk about peer-to-peer lending as a whole and as an option for you in your investment. So because these companies aren't like traditional banks, they don't have as much overhead, they can essentially charge less interest for the loans as they give them out, and then they share in those profits with the investors like us or like me that are now funding these notes and funding these loans. So essentially, if you have great credit score and a good income, you could get a loan for pretty much anything from debt consolidation to a home renovation for as little as 6% interest rates. And for those who don't have perfect credit or phenomenal credit, you're looking at an interest rate of roughly 27% is the high point. You can create your account, and then you would select the loan that you want to essentially fund, and you can do that with as little as $25. As that person makes monthly payments on that loan to pay it down, based on the percentage of the loan that you funded, you would then get money put back into your account as passive income. Which leads us right into the second positive, right? Which is you can determine how much risk you're taking. If you want essentially a lower risk, but you want to make sure that it's safe and much more secure, then you can pick the ones that they rank as A. And then if you want a higher return, what you would do is then select those loans that are rated, D and E and F, and they're a lot more risky than the A, of course, but they're going to give you a much bigger return. So the other positive is you can essentially select, based on your risk tolerance, who you want to give this money to and what rating, right? You can balance out your portfolio based on the A-rated borrowers, which are people that essentially have higher credit scores, higher income, and the likelihood that they're going to pay back these loans are much higher. Now, you are going to make less return on those loans versus someone who has very low credit score. It's a much riskier essentially investment, but because it's a more risky investment, they're going to give you a lot more return for your money. So it's up to you to balance your portfolio based on your own risk tolerance level. The third positive is that you can essentially turn your monthly returns into reinvestments. So essentially you're getting some passive income, and that passive income is being reinvested. So if the trend continues and not everybody defaults on the notes you selected, that initial investment that you put in a couple of months or even years could essentially, snowball, right? Just like an investment with the stock market would as well. All right, so on to the negatives. And here's where it gets really juicy. When I put in the $5,000, after the first month, I saw, I believe it was $90 essentially that was paid back to me, which is almost a 2% return on the initial $5,000 that I put to work. Now, this seemed almost too good to be true for me to be making a 2% return on the month-to-month basis. If that trend continued at the end of the year, I'd be at 24% return on that $5,000, which right now with the stock market again at its all-time high, it would be perfect. So I decided that I would put more money in. But before I do that, I wanted to just go through the fine print. Let me really understand this now that I've, essentially got my toes in the water. And there are a lot of red flags that I found. So the first negative that I encountered was the fees. Now, fees have to be probably the most hated word in any investor's dictionary. And Prosper tends, in Lending Club, charge 1%, which is actually not bad, but if you think about it from a different perspective, right? They're charging the borrower 6%, 1% to the person that's lending the money. And then if you compare that to the Vanguard or Fidelity funds, which charge 0.05, it's actually very high. So that automatically led me to my next question, because if my percentages are getting essentially more and more slim, well, I'd like to know how safe these investments are. And then what actually happens if somebody just decides to not pay, right? What if they essentially don't have any money? The first thing that people stop paying is any unsecured debt, right? So credit card and exactly unsecured loans. So as I did some more digging on this, I found some things that absolutely blew my mind. So according to Lending Club, they have borrowed out more than $32 billion. And out of those $32 billion, about $3 billion have not been paid back. So roughly that's about an 8% default rate. And what actually happens to those 8%, right? Out of the 5,000 that I put in, does that mean that 8% of that money is essentially gone? And if I pick bad notes, that percentage could even be higher. Those defaults then, get sold to a collection agency for pennies on the dollar. And then on top of that, Lending Club and even Prosper are going to take a cut on those pennies on the dollar. So the likelihood that you're actually going to get anything back on a loan that's defaulted, it's very slim. That should just be written off. The next negative that I absolutely hate is the lack of liquidity, right? So if you need this money, you can't use it. It's pretty much tied into like almost a 401k where you can't actually use that money except instead of a period of 40 years, it's actually 3 to 5, which is not as bad, but that money is still tied up. So if you wanted to essentially take that money, put it into another investment or use it because you have an emergency, well, it's not gonna happen unless you sell it at another market. I found a few that will buy your note essentially for a few pennies on the dollar as well. So you would still lose money. Well, maybe not all of it, but you would still lose most of it. So the next negative, and this one hurt, because I hadn't even considered this until I was reading through the fine print, but there is a taxation principle in peer-to-peer lending as well. And unfortunately, it's not a capital tax gain, which is roughly 15%. It's actually considered ordinary income. And here's why that sucks, because traditionally, if you were to invest in the stock market and you're a day trader, well, you're gonna pay ordinary gains on keeping those stocks for less than a year. But if you hold it for more than a year, you're essentially only gonna get taxed to 15% or capital tax gains. But your money in this case is tied up for 3 to 5 years, and you're essentially paying the ordinary income tax, which is gonna be considered your highest tax bracket. So it's a lose-lose. Your money is tied up and you're paying the higher tax on it. In this case, I'm not sure it would even make sense instead of investing in the stock market, because the return would have to be phenomenal for all of this to line up. All right, so the last negative, and I left this one for last because it's probably the worst one, so I apologize ahead of time, but it's the risk. And I've talked about the loans being defaulted before, but there's a whole other concept, and let's just put it this way. I'm not gonna be putting any more money in this anytime soon, at least until I see some of the dollars that are coming out of this thing. But here is the biggest risk, is that when someone is applying to borrow money, they don't actually do a background check or a credit check. They use the person's stated information and their stated income. And if you have been in this financial world for quite some time, the last time we used stated income was in 2007, 2008. Because essentially, although it is a fraud to lie in an application like this, what are the chances that these companies are actually hiring detectives and private investigators to go track these people down and find them? It's probably just better to take the risk, and then if they default at that 8% rate, they're still making a lot of money, because the company itself, like Lending Club or Prosper, don't actually assume any of the risk. If a loan gets defaulted, none of their money went into funding that loan. It's our money, right? It's our investment that essentially gets lost. And if they collect some of it back, they still take their full percentage points off of the cents on the dollar that they buy the loan back for. So this whole thing is very, very risky, from the point the borrower creates the account and puts in all their stated information to the point that maybe they stop making payments. The whole thing is very risky. All right, guys, that is it for peer-to-peer lending. I can't actually pull my money out, so I am stuck with the $5,000 in. If you're curious on how this whole thing is going, I'll do a follow-up video in a few weeks or months from now, actually, is probably better, and it'll give you a better idea on what you can do with that money. If you need an alternative, just hold it for now, because I feel like taking on this risk or holding it in cash, I'd probably just hold it in cash if I had known beforehand. But look, this is why this video is here, and this is why this channel exists, so that you don't have to make the same mistakes I do, right? So if you like this video, consider subscribing, and I'll see you guys in the next one.